Anne, can you hear me? This is
Yes,
Bart.
but I've unmuted us. Yes.
Okay, that's good.
So, and our attendees can hear us also.
Okay, great.
So, let's start. A very warm welcome to all attendees joining us to our webinar at lunchtime today. I'm very happy to have Professor Bart Basens presenting state-of-the-art in credit risk modeling today. My name is Anne-Kathrin Bogner-Hamle from SAS Education in Germany, and I have some organizational hints for you. All attendees are muted, but you can send a message or a question through the tool, and you can also raise your hand, and I'm going to try to monitor this during the session so that you can contact me. And the session will be recorded, and you will be able to download the recording afterwards. So, Bart, please start.
Okay, great. Thanks, Anne-Kathrin. Here you can see our coordinates, the coordinates of the moderator, Anne-Kathrin, as she just introduced herself, and myself. And here you can see some of the guidelines that she just provided. You can also find our LinkedIn and Xing profile there in case you would like to connect. Feel free to connect either to Anne-Kathrin or myself. Maybe first of all, a little bit of introduction about myself. So my name is Bart Basens, and I'm joining you today from Leuven. Leuven, which is a city in Belgium quite close to Brussels. Leuven is known for two things. It's known for having an excellent university and also known for, obviously, beer, because this is something that Belgians are known for. I studied at the Catholic University of Leuven, which is also the university I work right now, and I finished my PhD there on credit scoring and using machine learning, actually, to do credit scoring already in 2003. I am currently a professor of big data and analytics at KU Leuven, and I'm also partly connected to the University of Southampton. My research is analytics and big data applied in a variety of different settings. So we cover credit risk modeling, but we also do marketing analytics, we do fraud analytics, we do HR analytics, etc. We have a YouTube, Facebook, and Twitter account. It's named Data Mining Apps, and this is also the name of my website, www.dataminingapps.com. On the YouTube account and on my website, you will find lots of free movies discussing our recent research findings and even some of my courses, so you can have a look at them for free. I also recently published 2 books on the topic, which you can see here. My first book was Analytics in a Big Data World. I call it the Blue Book. And the other one is Fraud Analytics, which is my Green Book, which is the most recent one. So in case big data and analytics keep you up awake at night, I can definitely recommend you to take a look at one of my books, because I'm sure they'll put you back to sleep right away. Good. What is the aim of today's session? Well, there's 2 things I would like to do with you today. I would like to give you an overview of the state-of-the-art in credit risk modeling. This is based upon 2 sources of information. First of all, this is based upon research that we have been doing in the area, but it's also based upon some industry experience that we have accumulated throughout the past years, having collaborated with a worldwide network of financial institutions. Once we have gone through this material, I would like to give you an overview of some of the courses that I have developed together with SAS, discussing some of the topics which are covered in the presentation. And one of these courses is a credit risk modeling course. It's my most popular course, which we also recently transformed into an e-learning version. In other words, a version which you can follow on the internet at your own pace. It's a self-paced e-learning version. So at the end of this course, I would like to give you an overview of the self-paced e-learning version of my credit risk modeling course, which you can register for if interested. So first, we're going to start with a very quick introduction. Then we're going to zoom into data quality. Data is a key ingredient of any credit risk model, so you better make sure that it's of good quality. Then we have model requirements. There are various requirements that credit risk models should satisfy, so we're going to give some extensive comment on that as well. Then we're going to zoom into the key difference between model discrimination and calibration, and we'll finish by giving some input on model validation. Well, If you look at credit risk modeling, or let's call it credit risk analytics, you'll see that today this is more important than ever before, because analytical models are more than ever going to steer the strategic decisions of financial institutions or banks. If you think about credit risk models, then those models will be used to predict all kinds of credit risk related measures. They will predict default risk, the risk of defaulting on a loan obligation, such as a mortgage, for example, but they will also predict loss risk and exposure risk. These three types of elements will then be combined to calculate both the expected and unexpected losses a financial institution is exposed to. In turn, these loss estimates will then be used to determine the optimal amount of provisions or buffer capital a financial institution should hold in order to protect both itself, its environment, and its savings depositors. So you can see that if I have an error in my models, it will directly have an impact on the safety of the financial institution itself and the environment in which it operates. Given the strategic importance of credit risk models, we have seen all kinds of regulatory guidelines being introduced to help financial institutions build analytical credit risk models. And undoubtedly, you have heard of the Basel II, Basel III, and in insurance also of the Solvency II Accords. In essence, these accords are analytical accords. Analytical accords which carefully specify both the inputs and the outputs of the analytical credit risk models. These accords have been put forward by regulators such as the Bank of International Settlements situated in Basel upon close collaboration and close inspection of the financial industry. So if you look at the Basel Accords, for example, they usually work with three key input parameters, which are all very carefully defined in the accord itself. The first important parameter is the probability of default, or PD. As the Basel Accord and some European translation thereof stipulates it, the probability of default is the probability of default of a counterparty measured over a one-year period. Very important here is that this is a probability. A probability, as you may know, is always a number between 0 and 1. There is a key distinction between a probability and a credit score. A credit score can be any number, and credit scores are usually unbounded. A credit score can actually also be negative. For example, if you look at credit scores as they are offered in the United States by the leading credit agencies such as Equifax and Experian, there we have FICO scores that range between 300 and 850. So a credit score can be any number, but the Basel Accord enforces us to not only use credit scores, but also probabilities of default measured during a one-year forward-looking time horizon. A second important parameter is the EAD, the exposure at default. The exposure at default is the amount outstanding. So if I started off with a mortgage of 200,000 euros and today I still owe 50,000 euros to the bank, then my EAD is 50,000 euros. EAD, or exposure at default, is usually very easy to determine for on-balance sheet exposures such as mortgage loans, car loans, installment loans, etc. It is a lot less straightforward to determine for off-balance sheet exposures such as credit lines, or in the United States they have HELOCs, home equity lines of credit, or credit cards, because a credit card has a varying exposure. If I look at my credit card right now, I have a currently consumed amount, but it can go up to my credit limit any moment. So if you're modeling exposure at default, or EAD, for credit cards, you need to model credit conversion factors, which are going to measure how much of the unused credit is likely to be converted into credit upon default. A third important parameter is the loss given default, or LGD. And the loss given default tells me how much of my exposure, my outstanding exposure, or my EAD, is likely to be lost upon default. In quantifying or predicting LGD, you should obviously carefully take into account any collateral that may have been provided to mitigate the credit risk. So those three key parameters, PD, EAD, and LGD, are then combined by the Basel Accord in order to calculate both the expected and the unexpected loss. The expected loss represents the average loss and can be easily obtained by multiplying the PD with the LGD and the EAD. This is just the average, and obviously it's also interesting for banks to look at the volatility, or in other words, the unexpected loss. The unexpected loss is a function also of those three risk parameters, and in the Basel Accord this is calculated using a value at risk approach as it was worked out based upon the Merton model. Now, the way those three key risk parameters are modeled, and the way I also discuss it in my credit risk modeling and e-learning course, is according to a three-layer architecture which you see right here. At level 0 we have the data, the raw data. When I say data, I am basically referring to any type of data. That could be internal data, transactional data, socio-demographic data. It could be external data, data that you gathered through credit poolers, credit reference agencies like Equifax, Experian, or I know that many German colleagues are also joining. So in Germany you have a very good credit bureau which is called the Schufa. It's a very good credit bureau. I visited them a couple of years ago. And then we also have expert judgment, which is qualitative data based upon the experience and the business insight of the credit expert. This data will then feed into level 1. Level 1, where we will create our credit risk models, be it a PD model, an LGD, or an EAD model. And in a PD setting, this will usually boil down to an application scorecard or a behavioral scorecard. An application scorecard will score credit applications at time of loan origination. So that means as soon as you apply for a mortgage, a scorecard will be used to see what's your credit worthiness. A behavioral scorecard is part of the ongoing credit risk monitoring. So that means that every one of us today, I guess most of us today, either have a credit card or a car loan or etc. Well, your bank today will look at your recent behavior. It will look at your checking account, your savings account, whether you changed home address and so on, and calculate a behavioral score to see whether you're likely to default in the next 1 year or so. Very important is that this level 1 provides you with a scoring mechanism or a ranking mechanism. High scores will be assigned to good credit counterparts and low scores will be assigned to bad credit counterparts. But the Basel Accord necessitates a second level up on top. The Basel Accord talks about ratings and PDs. A rating or segment or cluster or pool, as it is sometimes referred to, is a homogeneous grouping, a grouping of obligors which are similar in terms of PD, for example. Those ratings are usually constructed based upon the application or behavioral scores themselves. And each of those ratings then needs to come with a PD. And a PD is a cardinal measure of credit risk. It's a probability of default which measures the likelihood of going into default in the next 1 year. And usually this PD is calibrated or determined based upon 5 years of historical data. The key innovation that the Basel Accord brought along was essentially the second level. In what follows, I would like to briefly discuss a couple of challenges and a couple of recent research insights across these three levels. But let's first zoom into PD modeling. If you look at PD modeling, as I already told you, then application and behavioral credit scoring are two essential tools in quantifying your default ratings and their accompanying PDs. In terms of application and behavioral scoring, we can see that most of these models are built using logistic regression. This is one of the most popular analytical techniques used in the industry nowadays. And the logistic regression models usually have somewhere between 10 to 15 characteristics. For application scoring, the area under the ROC curve is a very important characteristic. It tells you how well your scores are ranking good customers and bad customers. Or in other words, how well your scores or your scoring model is assigning high scores for the good counterparties and low scores for the bad counterparties. And there you can see some AUC ranges. For application scoring, depending upon the data and its quality, it varies between 70 to 85%. For behavioral credit scoring, it is between 80 to 90%. I also included some benchmarks from fraud detection and churn detection, which we recently obtained in some of our research. But you can see that application and behavioral credit scoring already have quite good performance. Obviously, the question is, how can we further boost this performance? Because if we can improve the ranking of our application and behavioral credit scoring models, it will have a huge impact on the quality of our PD models, which will then allow us to better determine both the expected and unexpected losses. Well, if you want to improve the performance of both your application and behavioral credit scoring models, there are two strategies that you can aim for. The first strategy is use very complex analytical modeling techniques such as neural networks, support vector machines, and random forests. This has some nice benefits to it because those techniques usually have universal approximation properties. That means that they can allow to model very complex, nonlinear relationships. We've seen neural networks and especially random forests getting very popular these days in fraud detection and in marketing applications such as churn prediction and response modeling. But they are not very popular in credit risk modeling. Why not? Because in credit risk modeling, all your models need to be validated. In Germany, they need to be validated by the Deutsche Bundesbank, for example. That means that we need white box models. We need models which are transparent, which can be easily understood and interpreted. That's why for credit scoring, we have to continue and pursue a second strategy, which is work on the ingredient of your model. We're not going to work on the modeling technique, but on the key ingredient, which is the data. In other words, we're going to get an idea about the data, see whether we can enrich it with any kind of external data or data that we have not considered up to this very moment, and heavily work on our data quality. That's really very important because then we improve the ingredient of our analytical model. Data quality is very important, especially if you think of the GIGO principle. GIGO says garbage in, garbage out. Bad data gives you bad models. Very important to be aware of is that your data will never be perfect. If you wait until you have perfect data, then you're never going to get anything done. But what you can do is you can try to diagnose your data quality issues and try to remedy them as much as possible. Because in many cases, especially in credit risk modeling, simple analytical models give very good performance. So the best way to improve your data quality is not that much by working on the modeling technique, but working on the data. That's really very important. If you talk about data quality, there are various types of data quality criteria that you can consider. First of all, there's data accuracy. To what extent is the data accurately representing what it is supposed to represent? Here we're looking at outliers, for example. And if you think about outliers, then that is not as straightforward as it initially may sound. Because think about an outlier. Somebody's age is 300 years old. That's an outlier, and we know that this is an incorrect value. But if you think of somebody's income as being 1 million euros, that's also an outlier, but not necessarily an invalid observation. So the distinction between valid and invalid outliers should definitely be adopted, or invalid and valid observations should definitely be made when you're talking about data accuracy. Data completeness refers to missing data. Missing data could be relevant data. I did not tell you my income. My income is missing. But missing income could imply that I am unemployed. Now, being unemployed is very useful information to be aware of if you're doing default or PD modeling, or even loss or LGD modeling. Data bias and sampling. For those of you working in application scoring, you may have heard of the reject inference problem, which specifies that you only have information upon the people that you rejected in the past. So you can only use that subset of people to build your application scorecard models from. Obviously, this poses a huge data bias problem, which you have to be aware of and which you have to remedy as much as possible. I am convinced that you can never totally get rid of data bias because a data sample is always biased towards the time frame during which it was taken, the policy or strategy adopted by the financial institution, etc. But you should be aware of the data bias and know how it might impact your models and any results coming from that. Data definition. How is data defined? For example, in corporate credit risk modeling, we tend to use a lot of ratio variables, like ratio variables measuring financial solvency, liquidity, profitability, etc. Ratio variables are very interesting, but can pose a lot of problems, like what happens if the denominator becomes 0? How do you take into account very skewed distributions for ratio variables, which are quite common? Should we take a logarithmic transformation, and so on? Taking a logarithmic transformation could be a means to make the distribution more symmetric and as such enrich your data. There are plenty of more data quality criteria that you can consider, and I've listed some of them here. I'm not going to extensively go through them, but from a credit risk perspective, I believe the most important ones are the ones I listed on my previous slide: accuracy, completeness, bias, definition, and to a certain extent also data recency. We did some research on data quality. We kind of participated in we actually organized a worldwide survey whereby we had more than 50 banks participating. Maybe some of these banks are also present in the presentation here today. We focused on credit risk analytics, and we basically queried the banks, asking them about any data quality issues that they have in building PD models, LGD, and EAD models. But I can tell you that most banks indicated that between 10 to 20% of their data suffer from data quality problems. That's quite a lot if you know that this data, that this data is being used to build PD, LGD, and EAD models, which are in turn being used to determine the expected unexpected losses, which are in turn being used to determine the provisions and capital buffers in the bank, which are used to protect our savings depositors. If we ask for many of the problems, where the problems originate from, we often got the answer: manual data entry and consistent corporate-wide data representation. If we then also queried them about why do you invest in data quality, then the reason we often got was regulatory and compliance, because we have to. And that's very unfortunate because you don't see a natural belief with banks, and actually not only with banks, but many parties working in the industry, in the value of having good data. I think it's far more important to invest in data than to invest in techniques such as random forest, neural networks, and so on, because the gains you get from investing in data are a lot higher. Now, the thing with data quality is that we can complain and nag about it, but in the short term, there's not a good solution. If your data is bad, it's of bad data quality. So in the short term, you can only deal with it by using very sophisticated statistical procedures, such as missing value imputation, such as data transformations using logarithmic transformations, or maybe a little bit more sophisticated using box-Cox transformations, or using sophisticated coarse classification schemes, etc. But if it's really bad, you may have to resort to data poolers or external parties. In the long term, you should aim to rebuild your data entry processes and make sure you have enough validation constraints, integrity constraints built into the processes to avoid bad data from slipping into your models. If you build your credit risk models, there are various requirements that you should consider. First of all, like analytical or statistical performance. To what extent do the models accurately predict credit risk, whether it's default, loss, or exposure risk? And believe me, you can do a PhD on this topic. I actually had some PhD students in the past working on just quantifying the performance of an analytical model. But an analytical model should do more than provide statistical performance, especially when you're working in credit risk modeling. It should be interpretable. It should be a white box. It should be transparent, such that if I deny credit to an applicant, I am capable of explaining why credit has been denied. It should also be operationally efficient. How much effort is needed to run my scorecards, to gather the data and do online real-time scoring? But also how much effort is needed to monitor or backtest the models. Next, and very important, is economical cost. What is the cost of actually running, building, and maintaining my analytical credit risk models? And ideally, I also want to have an idea about the return on my analytical credit risk models, right? So, such as the RAROC, for example, the risk-adjusted return on capital. This is very important. So here we're looking at things like total cost of ownership, which is usually not that difficult to quantify, and the return, which is somewhat less obvious to quantify. And finally, more than in any other setting, in credit risk modeling, regulatory compliance is a very important issue. This refers to the extent to which the models have been built in line with the regulation. Now, very important, if you look at this regulatory compliance issue, is the difference between model discrimination and model calibration. Before the regulatory accords, Basel 1, 2, and 3 had been introduced, credit scoring models were aimed at discriminating. As the term suggested, they were only looking at scoring, assigning high scores to good customers, low scores to bad customers. We were not interested in the exact probability of a default occurring. We would just like to know who are our most risky customers and make sure that we do not give credit to them. With the introduction of the Basel guidelines, our models need to do more than only discrimination. They need to provide model calibration. That means that they need to provide accurate probabilities, PDs, measured between 0 and 1. Now, this puts some huge challenges forward, like how are we going to migrate from scores, like application behavioral scores, to probabilities? How can we make sense that we can measure default or credit risk in an absolute way? One of the key inputs to appropriately do this is the environment in which a credit risk model operates. In other words, the macroeconomic environment. So here you can see the difference between model discrimination and model calibration. To the left of my slide, you have a classical application scorecard with age, gender, and salary. Each of those characteristics have been categorized or course classified and assigned points to them. The more points, the better the credit quality. Some of you may notice that gender and age in there and say this is not regulatory compliant because you cannot discriminate based upon age and gender. That's true. In most countries, you cannot discriminate credit risk based upon age and gender. We all know that females are less risky than males, but it cannot show up as a characteristic in our scorecard. Here, I use it for the sake of having a simple example. In my e-learning course and in my credit risk course, I extensively discuss how you can build those models. And I also extensively discussed how you can do the thing to the right, which is model calibration. So to the right, you can see that we have a pool of credit customers which are assigned a rating, an internal rating, hence the name internal rating-based approach, and which are characterized by means of a varying default rate. Based upon this historical default rate, we need to extrapolate to the future or calibrate as we refer to it. We need to calibrate the PD. And PD calibration, or extrapolation towards the future, is usually done based upon two sources of information. Based upon the historical pattern, as you see it here, and based upon your expectations about the future. So this model calibration is a new thing that the Basel Accord adds to our current credit risk modeling practice. And there's a lot of things that are getting complicated in terms of calibration because we have to cluster our analytical outputs or scores into pools. This is what we call a semi-supervised learning exercise in complex terms. It means we have a continuous range of scores. Think of it as a FICO score between 300 and 850, and we have to put it into bins. And usually, the number of bins depends upon the homogeneity of the obligors in terms of default risk. But I can tell you that the number of ratings or bins ranges somewhere between 7 to 15, possibly 20. For each of these pools or ratings, because I use ratings and pools interchangeably here, we then need to relate it to macroeconomic environmental variables. And if I talk about macroeconomic environmental variables, I'm particularly referring to variables such as the GDP, gross domestic product, inflation, and unemployment, and in certain areas also house pricing indices. The way we can relate to that is using very sophisticated forecasting techniques. Forecasting is getting very important in the analytical industry today. And unfortunately, we see a lack of expertise of people working on forecasting. Popular forecasting techniques, or ARIMA techniques, which stands for Autoregressive Integrated Moving Average, VAR techniques, any kind of other techniques that allow you to work with a time series of data and look at the historical fluctuation of important drivers such as default rates, loss rates, exposure rates, and so on. Once we've built those time series models, we can actually do the calibration and come up with PDs. We'll also look at creating those ratings and PDs will also allow us to see how customers migrate from one rating to another rating, right? Whether I'm migrating from A to B, or maybe from AAA to AA, or maybe from AA to BBB, and so on. So it will allow me to get a thorough insight into the rating mobility in my credit portfolio, which will also give me insight into how sensitive my analytical models, my credit risk models are with respect to temporary fluctuations. One then often relates that to the idea of the rating philosophy, whereby two extreme rating philosophies are point in time and through the cycle. Point in time means that your ratings are very volatile and our customers or obligors quickly move from one rating category to another due to very cyclical movements. This is as opposed to through the cycle ratings, which measure default risk through a credit cycle, hence providing a more stable, robust, long-term credit risk perspective. You can see our model architecture once more. So remember the data where we had internal, external data, and expert input data. Discrimination where we had a scorecard. And in PD modeling, this usually boils down to a logistic regression scorecard. It's one of the best models and the most popular models used in the industry nowadays. Logistic regression is a very good model. One of the key frustrations during my PhD was that logistic regression performed so good. And the calibration, or second level, is then where we have the ratings and the calibration, which we will obtain by embedding macroeconomic effects into our models. A side benefit of introducing the macroeconomy into our credit risk models is stress testing. Stress testing means that you want to evaluate the sensitivity of your models to adverse stress events. Factors or events that happen into your environment and which have a bad influence on your PDs, LGDs, and EADs. You can think of various ways of stress testing your credit risk models. Usually, banks are going to start by conducting some very simple, straightforward sensitivity analysis. Again, by making use of this multi-level model architecture, they will come up with a scenario and say, like, what happens if I would see an income decrease of 10% in my population? That's a data-driven stress test. So I start at the data level and I simulate the effect of having everybody decrease their income by 10%. I simulate the impact on the discrimination or scores, on the ratings, and on the PDs. I can also do a sensitivity-based stress test on the discrimination level and say what happens if everybody's behavioral or application score drops with 5%. These are sensitivity-based stress test analyses, and this is typically the type of stress testing that you're going to start off with. But as you become more sophisticated at it, you will start doing scenario analysis, and you'll look at a multitude of events happening together, which is what we call a scenario. You will say, what happens if in my population I see an income decrease of 5%, and at the same time I see a collapse of the real estate market, giving me a rise of my loan to value ratios, right? Loan to value, or LTV, which is a very important ratio to model LGD. So you have multiple impacts simultaneously, which have been nicely combined into a scenario of which you want to gauge the impact on your credit risk models. Those scenarios can be historical scenarios as they happened in the past, or hypothetical scenarios which have not happened in the past but could happen in the future. Common challenges are, however, that we have a lack of historical data, although this is getting better and better if you look at many stress testing practices and models in today's financial institutions. Ideally, when you look at stress testing, you should also integrate risk across portfolios, which is not that easy. So that's another important challenge. Model risk is a very important component if you talk about credit risk model building and stress testing, because as George Box put it, essentially all models are wrong, but some are useful. Now your models can be wrong, but still be useful. You will never have a perfect model. As soon as you build a credit risk model, it is outdated because a credit risk model is always conditional upon your historical data and the historical environment. Your future environments will never be identical to your historical environment. So as soon as you build a model, bring it into production, it is lagging behind the facts, but yet that does not turn it unuseful. Some models are very bad, but we don't have much alternative. If you look at default risk prediction, for example, usually, as I mentioned before when I gave you the benchmarks for application and behavioral scoring, you can see that those models are very good, but if you look at loss or LGD prediction, those models unfortunately are very bad. When I say very bad, I'm referring to R-squared measurements. R-squared is a very important performance measure for LGD. Well, the R-squared rarely exceeds 20%. I've seen LGD models that had R-squared 10 to 15%, which is pretty low, and you can complain about it, but that's what you have, so that's what you have to work with. So one way of dealing with this model risk or model imperfection is by using conservative parameter calibration. That means that you're going to put an upward pressure on your PD and LGD. If you think that the LGD is 70%, you may want to use 80% instead to compensate for model imperfection. It is better to overestimate risk and to be overprotected than to underestimate risk and be underprotected and go bankrupt. That's the idea of conservative parameter calibration. It means that you compensate for model risk by adding a margin of uncertainty to your PD and LGD estimates. And for LGD, this is a lot more important than for PD, because LGD is a lot harder to estimate than PD. Obviously, once you build your models, that's not where it's going to stop, because your models will be used in production. You will start using them to calculate both expected and unexpected loss, and in other words, also to calculate your provisions and capital buffers. But your analytical models or your credit risk models only have a limited lifespan, because as I told you before, as soon as you build a credit risk model and put it in production, it starts to get outdated, and it will be affected by various environmental factors. The first one is, well, that sample effect. Sample effects is not really an environmental factor, but it's a variation in your model outcome due to working on a limited sample. Due to having built your models on a limited sample, due to having calibrated your PDs on a limited sample of rating-specific data. A true external effect is the macroeconomy, which is constantly changing and which is never as it was before. Right? Then we also have internal effects, endogenous effects, strategy changes, population drifts, merger and acquisitions in the financial industry, as we witnessed them lately. So in reality, you have a nice mixture. I actually should not say nice. I should call it a challenging mixture of these, which are going to influence your PD, LGD, and EAD models and have an impact on them. So we need to constantly monitor our models and accompany our models with model monitoring frameworks. This is very crucial given the earlier issue that I said that those models steer the strategic decisions of the firm. And in order to do so appropriately, we need to make a distinction between quantitative validation, which is based upon data and statistics. And here I'm referring to backtesting. Backtesting means testing back. So that means if I have a rating B and I calibrated a PD for rating B of 5% for the next year, and I find out that the actual default rate was 8%, then I need to compare that 5% to the 8% and see whether I start to underestimate my default risk. This is not that easy as it sounds, as there exists a whole series of test statistics, like the binomial test, Hosmer-Lemshow test, the Vasicek one-factor test, which I also discuss in my course in order to do so. Same goes with LGD and EAD, and it's not only about backtesting, but it's also about benchmarking. Benchmarking means comparing. How do you know whether you have a good credit risk model, yes or no? Well, you don't unless you have a comparison. So you always need to compare your PD, LGD, and EAD models with a reference benchmark. And here you can have techniques like neural networks and random forest popping up. Your benchmarks can be perfectly black box, because the idea of a benchmark is to shed light on some of the shortcomings of your models. And it's perfectly okay if you use black box models there, because those models can tell us whether there are nonlinear relationships in the data. Nonlinear relationships which you can then go after and actually try to manually embed into your logistic regression so as to boost its performance. This is quantitative validation, and a lot can be said about it, but there's more to model validation than just quantitative validation. There's also qualitative validation, whereby you're going to diagnose your data quality issues, your data quality dimensions, see whether you have any significant data accuracy or completeness problems. You're going to look at model design, who designed the model, what's the perimeter of the model, what's the scope of the model, has the model been appropriately documented? That's really very important. And of course, excuse me, I have a bit of a cold here. Of course, also the involvement of senior management and the board of directors. To what extent have those people been actively involved in the setup, in the creation, the development, the validation, and the stress testing of your models? That's also something very important to be aware of. Backtesting, as I mentioned, is contrasting ex post realized numbers with ex ante estimates. There's just a whole bunch of test statistics to do that. Lots of challenges. What test statistics should we use? Which confidence levels should we be adopting? How do we deal with correlated behavior? Because if you look at many analytical models, like logistic regression, the assumption that is often made there is the IID assumption. Customer behavior is independent and identically distributed. Now, that is an assumption that is often invalid, not only in credit risk modeling, but also in settings like fraud detection. We recently did a lot of work on fraud detection. And I can tell you, also there, the IID assumption is not a valid assumption to assume. So how can you take into account correlated behavior? And the Basel Accord has given some input on that. Think about the asset correlation, which it has included in its value at risk calculation to look at the correlation between assets of a set of obligors. Many of those insights that have been put forward for capital calculation can also be successfully used for backtesting. Here you can see some backtesting example. These are some of the reports which I discussed more extensively in my course. To the left, you can see an example of a report of the System Stability Index, which is a very important backtesting report for diagnosing system stability or population drift, as we sometimes refer to it. To the right, you can see another report at level 1, which is the level of the discrimination, where we look at the AR. AR stands for accuracy ratio, sometimes also referred to as the Gini index, and it's a linear combination of the area under the ROC curve that we referred to earlier on. In fact, the AR is 2 times the AUC minus 1. You can see lots of traffic lights there, like green, yellow, and red. Green means that there's no problem, yellow means a minor problem, and red means a severe problem. These are all things that you have to decide during your backtesting exercise. How many traffic light colors are we going to use? How are we going to define them? Which statistics are we going to use, etc. Next to your validation diagnostics, as they come out of your backtesting exercise, you also need to come up with action plans, because what if your backtesting exercise finds that you significantly underestimate your PD? If it finds that, then you need to act upon it, and you need to first look at, is the model calibration okay or not okay? If the model calibration is okay, you can say, I'm safe, I can continue using my model. If it's not okay, then I have to go down my credit risk model architecture from level 2, which was the calibration level, to level 1, which is the discrimination level, and see whether my scores still appropriately discriminate my customers or obligors in terms of credit risk. If my model discrimination is still okay, then it means that I can quickly solve the problem at level 2 by recalibrating my model. If my model discrimination is not okay, I have to dig down one level further, which is the level of the data stability, and see whether I have been exposed to some data drift, some shifts in my distributions because of strategy changes, environmental changes, etc. And if I have been exposed to that, I have to re-estimate my model. Contrary, if my data stability is okay, I can still try to tweak my model, although I have to be honest that this is not that easy as it may initially sound. Okay, so this is in a nutshell a couple of things based upon some of the projects we worked on. Some of the key lessons, some of the key takeaways are that the best way to improve the performance of an analytical model, if you ask me, is not that much by looking at neural networks or random forests, but it's working on data quality. Data quality which has a short-term and a long-term side to it. Short-term, we have to look at statistical analytical procedures to deal with it. In the long term, you have to carefully think about redesigning your data entry processes. I told you that a good credit risk model should also do more than giving good statistical performance. We looked at model interpretability, operational efficiency, economical cost, and regulatory compliance. We also zoomed into the difference between discrimination and calibration and bringing the macroeconomy into the model. The macroeconomy, which you typically include at level 2 of your credit risk model by looking at ratings, calibrations, and they're including macroeconomic drivers like GDP, inflation, unemployment, and so on. We also introduced the idea of model risk and said a few words about model validation, backtesting, benchmarking, and action plans. Here you can see some of my research and my portal website, and I would like to give you some further input in case you'd be interested in some follow-up information. Here you can see 4 courses which I offer on analytics together with SAS. The first one is a 1-day course which I offer together with SAS. The second one, Advanced Analytics in a Big Data World, is a 3-day advanced analytics course, also developed in collaboration with SAS. Then I have a credit risk modeling course, which is also 3 days. My most recent course is fraud detection using supervised, unsupervised, and social network analytics. We teach those courses in 3 formats. We teach them in public classroom together with SAS Germany, for example, in SAS, with SAS, and we teach them on site. Sometimes we have firms asking us to do on site. And I have 2 courses which are available as self-paced e-learning courses. And this is Advanced Analytics in a Big Data World and Credit Risk Modeling. So my second and my third course are available as self-paced e-learning courses. That means that you can log on to the internet whenever you want. You can register for the course, and then you can look at the videos whenever you want, as many times you want during 1 year. Right? I can tell you that unfortunately this is not for free. Together with SAS, we spent quite an amount of time in making those videos, editing those videos, and coming up with the whole concept. So there is a price that comes with it and that you can find on the websites indicated. Another question I get is to what extent the courses focus on SAS. Well, 80% of all my courses are software agnostic or software independent. They are not focusing on SAS. We are just focusing on explaining some of the concepts, modeling methodologies. And then we also give the remaining 20% or then demos using base SAS and SAS Enterprise Minor. I would just like to give you a very quick demo of my credit risk modeling course, the e-learning version thereof. So I will just log on to the SAS website where you can find my courses. And upon registration, you will have a personalized link like my training. You can see that here. So I click on it. And here you can see my two courses, credit risk modeling and advanced analytics. Go and look at credit risk modeling. So here you can see the entry screen that you will get, and then you can click on Start Course. As I said, this course is not focused on the software, it's focused on the concepts, and that's why you see all these concepts right here. Introduction to credit scoring, the Basel Accords, classification techniques for credit scoring, and so on. I also have special topics devoted to defining the default ratings, LGD modeling, EAD modeling, validating, and working with low default portfolios. Let's look at some of them. Measuring the performance of credit scoring classification methods. So here you can see a bunch of videos. Each of the videos is about 3 to 5 minutes, sometimes shorter, carefully edited. So here you can see a video which is going to explain to you how to construct an ROC curve that we referred to earlier on, which is a very important feature for measuring the performance of your application and behavioral scorecards. I will play the video. It comes with audio. You will probably not hear it because I'm using my audio now to talk to you, right? But it comes with audio. If every of those videos is also subtitled. So if you go like here, you get it subtitled. You can also see the script that comes with a video right here, right? We also have quizzes embedded, right? So here you can see a question, for example. This is a question about what we have been discussing. You can check the answer. Every lesson ends with an end of lesson quiz right here, which is a whole series of questions to see whether you correctly understood it. No worries, you can do the quizzes as many times you like. So if you want to do them, if you miss out, if you make a mistake, you would like to redo it again, that's fine. Upon completion of the course, you will also be able to get a certificate, right? So if you go to Help and Resources, you will be able to get a certificate and print it yourself. But in order to receive the certificate, you have to make sure that you saw all the videos and that you at least had 80% on all the quizzes. But that should be no problem because you can do the quizzes as many times you like. So you can basically, you could try out all combinations until you have 80%. Obviously, that's not the purpose. So this is the credit risk modeling course. It has been quite popular thus far, but I also have another course which is available in exactly the same format, which is Advanced Analytics in a Big Data World. It has topics like fraud detection. We discuss more on neural networks, ensemble methods, on social networks, on backtesting, on survival analysis, and so on. In case you would be interested in having any more information about any of these courses, you can always send me an email. Good. I think I'm about ready to conclude. I actually ready to maybe take, we have 5 minutes to take some questions. Anyone has a question you would like to ask me, you can answer it in the chat box, or you can just unmute your line and ask me a question.
Yes, or write in a question through the tool. Until now we have no questions.
Okay, so I need a question. I've written a fraud analytics book, so the first 2 people that are going to ask me a question get a free copy of the fraud analytics book.
Hey, that's great.
The first 2 people asking a question get a free copy of the fraud analytics book.
No heroes until now.
We'll have some.
Hmm?
Anyone interested to come online or answer a question in the chat box? Whatever question. I've never had a stupid question, and I've had quite a bit already, I could tell you.
Here, the first one. Okay.
Aha, that's good.
Oh,
got one.
Two questions. Okay.
Oh, very good.
Okay. Do you cover PIT models as part of course?
Yes, we cover PIT models as part of the course. We discuss point-in-time models, how you can measure this using rating mobility and migration diagnostics. We cover that as part of the course. Yes.
Okay.
So this question, if this question, you take.
Now we have 4 questions. Okay.
Okay.
I would like to know which method you refer to deal with low default portfolios.
Yeah, that's a very good question. So in the course, we discussed, let's see whether I still have it online. Let's just go online. You can see my screen, right?
Yep.
Okay, so here we can, to model a low number of defaults, we discuss various types of methods. We're gonna look at mapping to an external rating, how you can actually use external ratings as a proxy for credit risk. Then we're also going to talk about undersampling and oversampling. Let's see where I have the overview somewhere here. We're going to talk about undersampling and oversampling, but we also look at likelihood methods as they have been introduced by Dirk Taschi, which is a very smart German person who used to work for the Deutsche Bundesbank and then went to, I think he's now working at Lloyd's TSB, and he introduced a likelihood-based method to deal with low default portfolios. You can see it's being explained somewhere here, right? Here. No, it's here. Calibrating PD. So we discuss undersampling, oversampling, some newer developments. Smoothie, we discuss mappings to external ratings, and also some likelihood-based methods to deal with low defaults. Okay.
The next question, 12 months time horizon versus IFRS approach.
Sorry?
Bernd Krug. Bernd Krug asks if you refer to a 12-month time horizon or an IFRS approach.
In measuring PD, I refer to the 12-month time horizon as it was put forward by the Basel Accord, 12 months in the future.
Okay. Next question from Verena Überfeld. What's your opinion on reject inference? Is it worth using it to improve the model?
That's a very good question, really. We have seen some studies by some of my colleagues in Edinburgh, Jonathan Crook and some of his colleagues, where they tested the effect of reject inference. So, and they found no impact, or they found a very little impact, which made it actually not worthwhile to do so. So I've seen banks not doing it, and to be honest, I do not have a major problem with that because we do not have any scientific techniques yet to perfectly deal with reject inference. So I'm perfectly okay if you're not doing it. I have seen some financial institutions doing dealing with reject inference by using external data. And when I say external data, I'm referring to data from the credit bureau, whereby they take a sample of their past rejects, give it to the credit bureau, and ask the credit bureau for extra information about them. This obviously assumes that the privacy regulation and other local regulation allows you to do so. But if you would ask me, Bart, I'm not doing it, I would say it's not optimal, but I couldn't give you a better alternative because we don't have any scientifically. There are some ways of dealing with it, but many of the techniques that deal with reject inference, they solve the problem by introducing another problem. So they basically don't solve the problem. Okay?
Okay. Next question. What were the statistics for backtesting? Sorry.
Very good. So we're in my course. Let's have a look. I can do some commercial in the meantime. Here you can see the test statistics that we use. So we have backtesting PD at level 0. Here we're going to talk about system stability index. Backtesting PD at level 1. Here we talk about area under the ROC curve and Gini indices. At level 2, we will explain the binomial test, the Hosmer-Lemshow test, and give demos how to do them in SAS, the VESUCHEN one-factor, and the normal test. These are some tests which have been very popular to backtest your PD models. And we have similar tests for backtesting LGD and EAD models, with the exception that there your target variable is continuous.
Okay, great. Maxim Sidorov asks, which modeling techniques do you recommend to use for LGD modeling?
Very good. Which modeling techniques? There's like a technique which is called a fractional logit. There are a couple. There are two. Well, hang on. There's like 3 approaches that I can recommend. Depends a bit on the portfolio, but 3 approaches that I can recommend and which I've frequently seen in the industry. First of all is a fractional logit approach. A fractional logit approach means that you look at your LGD observations, and every observation with a loss, you actually duplicate it into 2 observations, one with a loss of 1 and the weight being the LGD, and the other observation has a binary indicator of 0 and the weight being the complement of the LGD. So you model LGD as a fractional logit whereby every LGD observation is duplicated into 2 observations, one with a label of 1 and the weight being the LGD, and the other one with a label of 0 and the weight being 1 minus the LGD. This is approach number 1. Approach number 2 is whereby you take a 2-stage model, and in the first stage you estimate whether you have a cure, yes or no, because if you look at many LGD distributions, they have a peak around 1. Or a peak around 0, a peak around 0 and a peak around 1. If you have a peak around 0, this basically boils down to a cure. So you have a 2-stage model in which you estimate cure, yes or no, and the second stage model is then a linear regression model, which is basically loss given loss. Given that you have a loss above 0, how much is it going to be? This is the second approach, and the third approach is using a regression tree. It's a decision tree, but whereby your target variable is continuous.
Okay. Alexandra Jovovich is asking, macro variables already have impact on other ratios and attributes in our scorecard. So are macro variables going to be significant for the model? And she's asking because macro variables are usually not statistically significant in some models she's seen.
A very good point. A very good point. I think I think if you look at the level 1 here, you can see you can see here level 1 create the model. Many of the models which are being created at level 1 are being estimated using data samples from 2 or 3 years time. Data samples with a duration of 2 or 3 years, right? At level 2, the idea is to introduce the macroeconomy not with a time frame of 2 or 3 years, but with a longer time frame, right? When I say a longer time frame, I'm usually thinking about 10 years or even longer. Obviously, this assumes you have the data. And there we often find, if you look at default rates, for example, we can see that they're strongly connected to macroeconomic variables. We may not find it at level 1 because there our time frame is too narrow. We only have 2 or 3 years of data. But at level 2, we can have 10, maybe more years of data, and there we can find significant macroeconomic effects.
Okay. Katharina Kaiser is asking, what are the main differences in modeling PD versus fraud model?
Very good question. We have a well-informed audience today.
Yeah.
I like that. I think that's a good question. I think not much, not many. The difference between credit risk and fraud is that in fraud sometimes black box models can be used, We've worked with a major European credit card provider, and I can tell you right now they are using random forests to detect fraud. In credit risk modeling, we cannot use random forests because we need interpretable white box models. Fraud models you can. Another difference between both is that the data sets are more skewed in fraud than in credit risk modeling. In credit risk modeling, the number of defaulters can range 5 to 10%. It's also pretty skewed. So 5 to 10% of your sample defaulters. In fraud detection, it's usually less than 1%. So the skewness problem that we have in credit risk modeling is even more pronounced in fraud detection.
Okay. Paul Schweikart is asking, would the use of SAS contribute to your coursework?
To my course, the use of SAS?
Mm-hmm.
Well, for me, SAS was an easy tool to give demos in. I know some of you may refer to R. R is a good tool, but one thing that you have to be careful with R is the regulatory compliance aspect, right? It means that as a bank, your financial models need to be regulatory validated. This is something that SAS offers that R has not. The quality control that you have in SAS has, it's a commercial tool, so it needs to have good quality, and it's a lot more available in SAS than it has in R. Obviously, many of the things that you can do with R, you can do in SAS and vice versa, but the reason I use SAS is because this is credit risk modeling and it has a regulatory compliance side to it. So it's very important that the reports that you produce with SAS are regulatory compliant, and this is something that SAS can guarantee, but not R.
Okay. I have a raised hand from Dr. Clovis Nyonti. I will unmute the line. Hello. Do you have a question?
Hello there.
Hi. Is there a question from Dr. Clovis Nyonti? I think
probably a mistake.
Sure. Could be. I would ask you to write the question in the chat or in the question tool. That would be easier. But we have another question. Do you have experience in using the concept of survival analysis for scorecard modeling? What do you think of it?
A very good question. I'm kind of getting all the questions that I like to have because during my talk, at some point I was thinking to say a bit about survival analysis. I think it's a great tool. I think we see more and more financial institutions using survival analysis, and I think it's the future for credit risk modeling. However, survival analysis is a very complicated statistical technique. I would not advise you to use survival analysis techniques as your first credit risk model that you develop. If you're new to the field, you're going to start with survival analysis as your first model. I think it will go wrong. I think if you're a newcomer to the field, you should start with logistic regression. However, once you have started and building your logistic regression models and put them into production, which is the stage many financial institutions are nowadays, the next step would be to use survival analysis. And survival analysis will allow you to predict default risk for any future moment in time, 3 months, 6 months, 9 months, 12 months, 15 months, etc. And you can also use it for LGD modeling. I think it's a great statistical technique, and it's definitely worth considering, yes.
Okay. So let's have a look. Okay. I think most of the questions are answered now.
And Katrine, can you send me the names and addresses of the first? Let's make it the first 4 people that ask questions. I'm in a good mood because I got so many good questions, and I still have 4 books on my desk right here. So the first 4 people that ask me a question,
okay.
Can you ask them to send me their?
I have the contact details, and I will provide you with them. Yeah.
Yeah. Ask them to send me their surface address, and I'll send the book.
Now here we have another question. What about the conservatism in PD target level estimation?
Very good question. There's not much conservatism needed in your PD models. The reason being is that the that the Basel Capital Accord, because of the VAR approximation, the value at risk approximation, already implicitly transforms your PD to a 99.9% worst case PD. So Basel already compensates for that when it calculates your unexpected loss. So that's why it is not needed for you to add a margin of conservatism. Otherwise, you're going to have double counting of your conservatism, which is not good. It does not have that margin of conservatism implicitly embedded for LGD. So that's why it actually asks you to come up with economic downturn LGD.
Okay.
Okay.
So I think now we have finished with questions. If there are any further questions when we have ended our presentation, feel free to contact Bart or myself, and we will try to answer afterwards.
Okay, great. Thanks everybody for attending, and maybe we speak or see each other at some later event.
Yeah, absolutely. Thanks, Bart. It was very interesting listening your presentation. Perhaps you could just click 2 slides forward, because I have 2 messages to the attendees. The first one is just the hint on our next webinar at lunchtime, taking place on January 26th. It's a preparation for the SAS Visual Analytics certification. Gut vorbereitet ist halb zertifiziert. And the last hint I have for you is the hint to our download site. You can download the slides and the recording on www.sas.de/lunchtime. We will have the material there, I think, until Friday, and then you will be able to download it. And when I end the webinar in the next minute, they will start a short feedback form, and I would be happy if you could give us your feedback just to see how you did like our webinar and if there is some room for improvement. Okay, so thank you very much, Bart. It really was a pleasure.
Yep,
and to all attendees, thank you for attending, and have a nice Christmas time, and hope to see you next year.
Have a nice Christmas. Nice Christmas to everybody. Bye-bye. Take care. Bye.